And so what is the ultimate reason why the debt ceiling could be breached? Well, it has to do with herpes. Well, hello there, my friends. Rafi here from the Endgame Investor with this week's silver report for Arcadia Economics. And yes, I'm wearing a shirt with a giraffe on it. I'm not sure if there's any meaning there, but I assume there is. I don't know why there's a giraffe on my shirt, but I don't really understand much these days about why the world is the way it is. But if there are any secret messages in wearing a giraffe on a shirt, let me know. It was a relatively quiet week in gold and silver this week, but we do have some interesting developments. First of all, we're going to go into the very short term in the spot price. I do see some danger of a decline in the spot price from the open interest. We're at open interest means the amount of silver contracts that are open, really. And we are at a high in the open interest. We're at about 160,000 contracts. We haven't seen that level since April 2022. And that could lead to a short-term decline in the spot price. I don't think this will apply to physical silver because premiums tend to rise when the spot price declines like that due to open interest smashes. And if you watch Chris's video with Andy Sheffman and Bill Holter this week, you'll know that the supply of junk silver especially is very tight. And premiums in junk silver, I think, are about 25-26% now, which is historically very high. And it looks like a bottom in premiums are in. We'll also look at U.S. sovereign credit default risk, which is the highest it's been even before 2008. This tends to happen every time the debt ceiling becomes a political issue again. And at this point, you have both Republicans and Democrats with humongous egos, neither of which are actually interested in cutting spending at all. It's all a show. So it depends how far they want to stretch it. And make the other side bleed or concede, or I don't know what these people are actually thinking, and they're all just a bunch of clowns, but it's possible, I guess, that the debt ceiling could lead to a temporary default in the Treasury market, which would drive several markets a little bit crazy, and it's possible it could happen. And by the credit default risk, the market is saying there's a high chance. So we'll see what happens. This one's a big one. The Fed predicts a recession for the first time ever. I did some research into Fed minutes going back to 2008, and I will just take Mish's word for it because Mish is the one who wrote this sentence that it's the first time they ever predicted a recession. But going back to 2008, they've only mentioned the word recession twice in any of their minutes. And they only mentioned as recession as a possibility. I think the first time was like December 2008, which everything was already collapsed by that point. So when the Fed predicts recession, it's something special. And we also have the New York Fed recession probability rising to the highest level since 1981, when interest rates were 20%. The German people are getting abused by their government again because the two remaining nuclear power plants just cut their service and shut down when the Germans are already paying astronomical prices for their electricity. And after this shutdown, prices are rising by another 45% for some providers. It's all crazy. German food prices are rising at a faster than 20% clip annually. And speaking of the debt ceiling, the federal government only has $109 billion left, which would last at about 2 weeks.
2 weeks. 2 weeks. 2 weeks. 2 weeks.
So they're going to have to raise this debt ceiling. This is the amount of money that they have to spend. So it might be 6 weeks or so because income taxes are coming in. April 15th was tax day. And finally, we have silver deliveries next week. So we'll cover that next week. And in the meantime, we will begin with this week's silver report brought to you by Fortuna Silver Mines, symbol FSM. There is no new news this week about the company, but I can show you some interesting technical indicators that we have confirmed is that we have a broken downtrend since silver squeeze. It has broken through as of, looks like October, November 2022, and we have established support at the 50-week moving average. But it looks here from the medium term from the 2020 bottom during the lockdowns, or near it, right? We have what looks like a 100% retracement. Depends where you want to count the bottom. If you want to count it all the way down here at the panic bottom, fine. So you could say what looks like a 90% retracement of the entire bull market from the lockdown lows to silver squeeze. So it looks like the cyclical bear is over and we are forming what looks like a technical triangle. Is that a thing? I'm not a big technical analyst, but yeah, it looks technically bullish and secure to me. And you can see, look here, the 200-week moving average. It hasn't really moved much at all for the last 5 years. And there's going to be a breakout here, I think, when it breaks out above the 200-week moving average. Is Fortuna Silver Mines right for you? Ask your broker today. Side effects may include owning stock in a mining company. So here we have the first slide. This is the open interest in silver, and that boxed area shows what happened last time. Open interest fell from around where it is now, 160,000, 165,000 contracts open. So we here see a fall about 165 contracts to about 140,000 in about a month. And that really took the price down from, what was it, about $27, $26 to eventually about $21 or a little bit below. That was a serious decline. It was hard on the silver bugs, and the fact that open interest has not fallen despite the price retracement over the past few days, and it has only climbed, is a little bit worrying that some of the longs are going to get squeezed out by the shorts. It might not happen, and this is all short term anyway. In the very short term, if you want to accumulate speculative positions and options, I wouldn't recommend that at this point. But for physical, it's not really going to make much of a difference, because if the spot price falls, premiums are going to rise. They're going to pay the same price anyway. So if you're looking to stack, keep doing it. If you're looking to initiate paper positions, I would hold off until probably after delivery day next week. Now, we talked about U.S. sovereign credit default risk. This chart is from Zero Hedge. You might have seen it. I'm not sure what WTF stands for. I'm very innocent. Okay, so we have the Lehman GFC crisis, great financial crisis here, and these credit default swaps were at 60, and in the U.S. debt downgrade, right, when S&P downgraded U.S. debt, and we called the Tea Party downgrade, blah, blah, blah. That was 70. What exactly these units are, I'm not sure. We have another debt ceiling crisis in 2013, up to about, it wasn't 70, it was 80. And now we're at a record high of 94.045. But something about the market is predicting that the U.S. is going to fall. I don't believe it. I don't think it's going to come right now, but there is a possibility, and I will show you why in this article. Debt ceiling fight shows stakes of Feinstein's Senate absence, Klobuchar says. And so what is the ultimate reason why the debt ceiling could be breached? Well, it has to do with herpes. The standoff over raising the U.S. federal government's $31.4 trillion debt ceiling illustrates the stakes of U.S. Senator Dianne Feinstein's lengthy absence from Washington. Feinstein, 89, faced calls from some fellow Democrats last week to resign her seat after being sidelined since early March by a bout of shingles. Shingles is the nice word for herpes simplex 2, the herpes virus, and what has been shown to possibly be a risk factor in shingles resurfacing in old people. I'll have you take a guess, but I'm not going to say anything. On Wednesday, she said she would temporarily step down from her spot on the Judiciary Committee while she recovers. So what's the problem? We are going to need her on the Senate floor eventually. We have things like the debt ceiling coming up, Klobuchar said in an interview on ABC's This Week's program. So basically they need Feinstein to vote on the debt ceiling, but she can't because she's got herpes. So there's that. Context, this is the amount of money left in the Fed's account, in the federal government's account, at the Federal Reserve. The federal government has a bank account with the Federal Reserve, and this is the amount of money that's in that account. Right now, they have $109 billion, and it's been going down. So you can see we're at a pretty near a post-lockdown era low. And we have here, if we zoom in on the 1-year chart, it went down about $60 billion last week. So by those numbers, if that trend continues, we have about 2 weeks of money left before the federal government defaults because they can't raise any more debt on net. Do I think that's going to happen? No, because we have some tax money from income tax day on April 15th coming in. Exactly how much, we don't know, but there's just rumors about California not paying income tax until October because of disaster areas or whatever happened there. It looks like we have probably about 5 to 6 weeks left of money before they have to raise the debt ceiling. And how's that going? Well, if we go to this article about Kevin McCarthy, who I think is the Speaker of the House. I mean, anyone's better than Pelosi, but McCarthy and House Republicans have sought to tie raising the debt ceiling to steep budget cuts, while President Joe Biden and congressional Democrats have urged Republicans to agree to a higher federal borrowing limit without condition. Failure to raise the debt ceiling risks plunging the U.S. government into default as soon as June, according to some estimates. Well, we're at April 21st now, and so 6 weeks, would bring us about into June. And so I think they're saying that, yes, some money is going to come into the Treasury account at the Fed because of tax day. But there's not much time left. And the question is, who has the biggest egos? And are the people with the biggest egos willing to bring the United States into a situation of temporary default? And that would be a lot of fun. Let's do it. I say let's do it. I'm up for some excitement. And now, Mike Shedlock of Mish Talk pointed something out to me that I'm not so surprised about, but it is kind of funny that the Fed actually predicted in its latest minutes release a recession for the first time ever. They never predict a recession. This time they're predicting a recession. Let's read it. The Fed predicts a recession first time ever. This is a paragraph from the minutes. Staff economic outlook. For some time, the forecast for the U.S. economy prepared by the staff featured subdued real GDP growth for this year and some softening in the labor market. Given their assessment of the potential economic effects of the recent bank executive developments, the staff's projection at the time of the March meeting included a mild recession starting later this year. Mild. Well, they have to put mild in, and they can't handle like spicy, like habanero recession or ghost pepper recession. I just made that up. It's probably the draft on my shirt that's inspiring me. And of course, the significance of a recession isn't really the recession part of it. It's the money printing that follows. And the recession will cause the biggest round of money printing ever because it always is bigger than the last round. And to be bigger than the last round, it's got to be like $10 trillion. The last round was about $5 trillion. So that'll be fun. And now, as I was browsing Mish's recent blogs, I found one where he says that the Fed has never predicted a recession, and this prediction of a recession is the very first time they are doing so. And so I did some research, going back to all the minutes, just clicking on a bunch of tabs, minutes, FOMC minutes, going back all the way to 2008, and I only found 2 mentions of the word recession in any of the minutes going back all the way to 2007. I went, previously to 2008 to see if they predicted it all. They didn't predict it. And there's minutes going back to, I think, all the way to 1935. So I didn't do like all every year, but it's pretty pathetic. Let's read those 2 mentions of the word recession. First mention of the word recession, going back all the way to 2007, was August 5th, 2008. And this is what they say about recession. That was just before the major crash of September 2008. But by this time, I think AIG had failed, Bear Stearns had failed, and Lehman had failed. And so here's the sentence with the word recession in it. In contrast, several other participants suggested that risks to the financial system had receded. Everything's fine now, August 2008, partly as a result of the implementation of by the Federal Reserve of special liquidity facilities, money printing, and that prevailing credit conditions were broadly consistent with the typical patterns observed during periods of weak growth or recession. So this mention of recession was basically the Fed saying, everything's fine, August 2008. What's the other mention of recession? Well, this takes place December 15th, 16th, 2008, meeting minutes. So the incidence of the word recession at that, there's 2 mentions of it. So the first one is here. Economic activity in most advanced foreign economies contracted in the third quarter, driven by sharp declines in investment and by significant negative contributions of net exports as the global recession took hold more strongly. And so we look at the second mention of the word recession. As financial market conditions worsened over the intermeeting period, investors seem to become more concerned about the likelihood of a deep and prolonged recession. This is already in December 2008, and the deep and prolonged recession ended in March 2009. The takeaway from here is that if the Fed's predicting a mild recession, we're headed for some very choppy waters in the Keynesian sense, and it's going to lead to the next round of money printing, which really has already started with the regional bank bailouts from March. Those have calmed the situation temporarily, but there's going to be another flare-up very soon. Exactly when and exactly what's going to be the trigger, nobody can ever know, but it's always clear in hindsight. It could be commercial mortgage-backed securities. It could be auto loans. It could be anything. But once it happens, we will know that gold and silver, but once it happens, we will be in the final round of money printing of this monetary system. That is my belief. That is my conviction. Or it could be something as stupid as the debt ceiling, where maybe one side thinks that if they force a default for one day, they will force the other side to capitulate. And then from there, the entire pyramid could collapse. And who knows? I don't think that's going to happen. But if it did, I would laugh. Because what else can you do in such a situation? We know it's all coming down anyway. It may as well come down for a stupid reason like that. This is Rafi of the Endgame Investor. If you enjoyed this silver report, then consider being my Patreon on Patreon, or patreon.com/endgameinvestor, where you'll get a weekly biblical commentary on this kind of stuff. And how do I plug it into ancient stories? It's pretty cool. I like it. And my patrons seem to as well. Or you can sign up for a 2-week free trial with the Endgame Investor at the link in the description below. But as always, I'll see you next week, and who knows what's coming.